Hello, welcome back. In this video we are talking about Starbucks, a company that I myself have used quite a lot. I happen to be an avid espresso aficionado, and especially when I was living in the US, I was buying Starbucks quite some. Now I know that some people will cringe about that, but I kind of like their coffee. Okay, so we can take a look at the financials. The company stock is down 42% since last year, and we need to be examining it for a potential buy here. Now, it's worth watching this video till the end because this company is a tale of positive and negative things, which we will examine both so that I can give you a better idea of whether it's worthwhile buying this one or not. The P/E ratio and the price to free cash flow are relatively low here, 19 and 18. Not too low, they could be lower for sure, but they seem to be within our limits. Now, that doesn't mean this is a buy, of course. We will examine that. The outstanding shares of the company are down about 20%. The company has been buying back shares a lot, and this gets reflected to their outstanding shares count. And this is good, of course, because we are now owners of a larger portion of the company, especially if we bought back in 2017, of course. Now, the total liabilities to free cash flow ratio is 8, which means that it would take about 8 years of our last year's free cash flow to pay back our total liabilities, meaning that we are a relatively solvent company, although we would like it to be less, about maybe 5 or 4 or less than that, really. So this is somewhere in between. It's a little bit more than I would like it to be. It doesn't necessarily mean that the company has a lot of debt. We will examine that, of course. Now, the 5-year revenue growth has been increasing with the net income growth and the free cash flow growth, yet not substantially. But the interesting thing to notice here is that the equity growth, which is in the negative, and it's actually negative equity as well. So it's growing negatively and it's going down into negative territory. So what's going on here? We will examine the details in the financial statements because we cannot really know what's happening based on looking at this. And this is why we have the financial statements. We can go there and examine the actual story. Okay. First of all, the debt to equity ratio is of course negative because negative equity, and the return on equity is also negative because negative equity. The net income margin of the company is fair at 14%. Now, another interesting thing, the dividend yield is sitting at 2.6, but we are very, very close to 50% in terms of the payout ratios. We're actually above that in terms of net income, and very, very close to that in terms of the free cash flow. So this means that this dividend may potentially not be super safe here. The company may eventually have some trouble paying the dividends, and we can take a little bit of a look and see what they have been doing in their history. They have been increasing their dividends historically, but again, we may see a little bit of a slump if the payout doesn't match the company's net income and free cash flow, especially because dividends are paid off of free cash flow. Now, I want to take a look at the income statement, see what's going on with this company. 22 billion in revenue to 29, so it's been increasing, not tremendously, but still increasing. And in terms of the net income, 2.8 to 4.1 is a pretty nice increase, so their profit is actually moving potentially even better than their revenue, although last year it wasn't great, maybe because of the pandemic, who knows. So, the balance sheet here, this one is super interesting because you will notice that their total equity is going down into negative territory. So what's going on here? What's happening? You will notice a massive increase in their total liabilities. And so we can use the tool to discover what is happening here. Take a look at this debt, 3.9 billion to 23.6 billion. This is a massive increase in terms of debt growth. You can actually see the growth numbers here, which means that the company is utilizing tons of leverage in order to potentially increase their earnings and basically do better financially, make more money. But this is actually creating a vast amount of total debt here, and we're looking at total liabilities that have been increasing tremendously. Now, remember, we had a factor of 8 in terms of the free cash flow to pay back all these total liabilities, but it looks like it keeps increasing, and this is something that I don't like to see. The long-term debt is also recorded as a non-current liability, of course, because it doesn't need to be paid in the next 12 months. But it is substantial, and depending on what kind of shareholder you are, you may want to reevaluate this kind of debt if you think it is substantial. I actually think that it is getting to substantial territory, and with the company's payout ratio being near 50%, I'm starting to get a little bit worried if I'm owning this company, is the thing. Now you will see that their net income is laid out here, And then the net cash provided by operating activities is laid out here. 5.9 is what happened in 2021. You will notice that the previous year was 1.6, which was less than the dividend the company had to pay. And so if this slump continues, then you can see how paying this kind of dividend may become unsustainable. And this is the problem that I'm potentially having with this company, with all this debt leverage that they have. And the net cash for investing activities is normal here. The company is investing in some investments here, purchase of investments, PPE, property, plant and equipment, normal stuff. And paying dividends, look at this, 2.1 billion is what they paid last year, 4.5 is what they made, it's about 50% is what we examined. And yeah, this starts to become a little bit too much, really. And I'm getting a little bit fearful that in the next few years, Starbucks may have to cut their dividends unless they continue at this rate. Now, they were making substantially more, like for example in 2018, but this is probably a one-off here, I'm assuming. Yeah, this is a change in working capital, so this has to be basically not be taken into account. This is about how they are about how much they are really making right now. And yeah, before that they made 114 million here and 3.24 billion. So this has to keep increasing to keep up with dividends paid here, which seem to be increasing yearly quite a lot. And from 1.4 went to 2.1 in about 5 years. That's pretty substantial. So yeah, you see what's going on with this company right now. It's a little bit of a debt leverage story, negative equity, doing well financially. They are making money. They were hit by the pandemic, it looks like, but they are still making quite good cash flow is the thing. So it may be worthwhile purchasing at the right price. Now, this is what I'm going to do with this company. I'm going to have an annual return of 15% because I have more risk here. The company is very debt leveraged. I don't like that too much. The negative equity is affecting me and I want to be making more if I take this investment for a ride. So this is why I'm asking the tool here to give me an annual return of 15% for Starbucks, while I typically use 13% here. I'm gonna go a little bit more conservative in this video. In the previous one I've asked it for a 13%. This one I'm gonna go a little bit more conservative because of the whole story and yeah, because of the market's decline lately and the potential of inflation and all that. I want to be buying it at a better price and at a very low price potentially if possible. So the revenue growth here, the revenue growth has been not a little bit low, generally speaking. I'm gonna go something like 3, 5, and 7 here. The net income margins are about the same every year. Actually, no, this year, yeah, apart from this year, which was really slacking here, yeah, previously you are seeing something like maybe 12 to 14 to 16, 12, 14, and 16 here. And free cash flow margins, I'm gonna use something typical like 90 here, 90 and 107. I'm gonna go 90, 95, and 100. And let's see what we're getting here. And so you will see that while Starbucks, of course, is a good company, and I'd love to have it in my portfolio right now, to buy it right now, the current price for current buyers may be a little bit too steep. So I have bought Starbucks in the past, I think at a lower price than this. But right now it seems like it may be a little bit overwhelming to buy the company because it's getting more debt leveraged, and at the current market I feel like it adds a little bit of extra risk to my portfolio. And so since that happens, I'd probably like to get it near $50 or so. I can try, if you're willing to do that, 13% and see what we're getting out of this one. And still we're above 50, but near 55 is where I would like to get it, and if possible even 50 or 45 even. So yeah, right now I think I'm probably not buying Starbucks based on what I'm saying. I like the company overall, but it may be it may not be worth of the risk right now, with especially with all these companies around that are potentially better targets, cheaper targets, and probably more worth of your money, really. So yeah, that's what I wanted to talk about in terms of Starbucks. A little bit of a more complex situation here. It's always your call, of course, if you're gonna buy or not. But thank you for watching the video regardless, and remember to like and subscribe if you liked the video. And remember, you can always become a patron from using Patreon. You can find links in the description box below this video, and this gives you access to this tool. You can do the same analysis that I have done with any single stock that you want if you get access. And of course support our efforts here. And thank you for watching this video. I'll see you in the next one. Bye bye.